We are easily hooked by the dopamine rush of a perfectly profitable chart. You apply a popular sniper indicator to your screen and suddenly it's calling every macro trend with a beautifully placed glowing signal. It feels like you just found the holy grail of trading. Most retail traders look at this and think, if I just connect this to an exchange API, I will make money in my sleep. At Passify, we don't believe this. Instead, we build automated trading systems for serious traders and funds. And today, I'm going to show you exactly why taking a retail indicator and plugging it into a bot is not algorithmic trading. It is an automated way to blow up your account instead. So let's look at the math. Take this popular script, the CAN-SARB sniper indicator. Look at the interface. You have dynamic risk management levels, a multi-factor dashboard, tracking relative strength, and volume profile metrics. It's frankly designed to look like a Bloomberg terminal. It looks like institutional grade software. But as an algorithmic developer, I do not care about the UI. I care about the underlying logic. So let's look at the source code. If you strip away the UI rendering, you will discover a massive retail trap. This highly sophisticated dashboard is completely disconnected from the actual trade signals. The core maths triggers every single long and short trade in the snipe system is nothing more than a basic 9-period and 21-period exponential moving average crossover. So the dashboard is just drawing pictures on your screen to build a false confidence in a lagging indicator. When you scroll back through the chart, your eyes naturally gravitate toward the massive sweeping trends. The EMA cross catches a historic bull run and the indicator looks like a genius. But moving averages react to trends. They do not predict them. So let me show you what happens when the market stops trending. During a sideways market, this sniper turns into a machine gun. It fires off late signals and gets stopped out over and over again in the chop. But it gets worse. We converted this exact indicator into a strict executable strategy. Look at this equity curve. On a pure frictionless backtest, it looks like it prints money. But real algos don't operate in a vacuum. They operate in live markets with brutal friction. I'm going to go into the settings right now and simulate live conditions. So I'm going to add a standard retail commission of 0.05% and I'll add just 2 ticks of slippage to account for execution latency. Watch the equity curve. Total account decimation. Death by 1,000 paper cuts. The small wins are completely erased by execution fees and the ranging market whipsaws drain the equity curve to absolute zero. This is exactly why retail traders lose money automating free indicators. So, how do actual quantitative developers fix this? We don't just optimize the moving average lengths, we build infrastructure. If we were to build a system like this at Passify, we would implement a market regime filter. Before the algo even looks at a moving average, we analyze volatility and trend strength. Look down here at the ADX indicator. When the market enters this chop, the trend strength mathematically collapses. If the system detects this ranging environment, it entirely disables the crossover logic. It physically prevents the bot from entering the meat grinder. We also build in latency tolerant execution layers so slippage doesn't eat your alpha. Real automated trading requires robust logic that filters out sideways chop and accounts for the friction of live execution. You cannot just automate a chart drawing. Before you waste months and thousands of dollars trying to automate a broken retail system, you need to stress test your logic. Stop trading illusions and start building resilient systems.